네, 글로벌 시황까지 체크를 하고 넘어왔습니다. 이번 시간은 월가 트레이더 버니의 미국 주식 시간인데요. 간밤에 뉴욕 증시가 이 브레이크 없이 급락세가 계속해서 연출이 되고 있기 때문에 오늘 국내 증시도 걱정이 앞섭니다만 그 전에 뉴욕 증시에서 지금 현재 월가에서 활동을 하고 계신 버니씨의 이 산업과 시장에 대한 연계성과 관련돼서 먼저 짚어보고 넘어오도록 하겠습니다. 준비해 주신 내용 함께 보시죠.
So let's think about how the markets work in general, okay? When the markets go up a lot and down a lot, and how these different sectors, the different industries relate to each other. Well, what we do find, okay, is that these industries or these sectors, like we talk about the technology sector, we talk about the consumer discretionary sector, we talk about the energy sector, the banking sector, all that. And there's about 12 main sectors in the market. Sometimes they get highly correlated, and other times they're not correlated. So when we look at what happened this year, okay, what we want to see is that as we rallied here into the top, we got really highly correlated. All the sectors peaked in November, December. They all basically went up together. And then starting in November, stuff started to break down. Some of the sectors stayed high, some of the sectors started to break down. And so what happens is when we look at the percentage of components that are correlated to each other, we saw a complete breakdown in the components at the beginning and into the depths of the rally. Okay, so what was going on there is people were selling sectors of the market that they thought had a high degree of risk and rotating into sectors of the market they thought were much more defensive, much more energy-based, and much more financial-based. Then we had a little bit of a peak right into the lows. And what happened right here is that everything started to tip back down again. And everything at the lows started to act the same way. And that's how we got out of this move, because when you sector rotate on the way down, that can lead to just further and further price declines until that non-correlation stops. Okay, then here you get very correlated, and what happens is off of the bottom, we became extraordinarily correlated again. Everything went up at the same time. So that's just a little bit of what happened going into the top of the market, down off the top of the market, why we sold off so much, breakdown in correlation, and now back up, and we've gotten almost too correlated in terms of everything's gone up at the same time. But now let's think about, let's look at some of the things, let's look at some of the sectors that I think are a little bit of a tipping point to be able to slow some of the components of the economy down. When we think about consumer spending and all that, what we think about is, in the United States, we buy a bunch of pickup trucks. Everybody loves a pickup truck. So the truck sales are now so significant relative to the total car sales, total automotive sales. The truck sales have become such a bigger and bigger component overall. People are buying more SUVs, people are buying more trucks than they did before, people are buying fewer sedans. So let's just look at, I picked up several different auto companies: Ford, Chevy, Dodge Ram, GMC, Toyota, Nissan, Chevrolet. So what we can see is on a month-by-month basis, what we're seeing is a lot of the companies are starting to break down. We've had lower sales in the month of March than we had from the month of February. Going forward on this, let's look at some more. Let's look at Jeep, let's look at another Ford, Honda, Hyundai, Nissan, and GMC Hummer and Rivian. And what we can see here is, again, the ones that have been positive are not that significant, and the ones that are negative on both a month and a year-to-date change have been fairly significant. That's telling me that there is a slowdown coming. whether we get into a recession or not, I think there's two things we have to think about with respect to that. Is it a mild short-term recession? Is it a deeper recession? And I just don't believe at 2.5% to 3% interest rates that we're going into a significant recession. When I traded back in the early 80s, we were at 15% interest rates, and those movements were fairly substantial, and that level of interest rates choked off growth in the economy. I just don't see that we're going to have a prolonged deep recession, given the fact that we're only going to be most likely at 2.5% or 3%, and I don't believe the Fed's going to have 12 interest rate hikes booked in before they get done. I believe we're going to probably have one more hike, another hike, and then after that, we're going to wait and see. Now, if we do get into a recession, what we want to look at is how deep those recessions go. And if I think that we're going into a growth slowdown or potentially a modest recession, because I think we'll get kicked out of that recession once the economy starts to slow down and potentially growth goes potentially negative for a quarter, with inflation getting taken away, I think the Fed is going to stop providing all this economic tightening that they're doing. They're going to be much more of a balanced to a positive liquidity mode, because that's what they've done every other time. I don't want to say they've quote unquote chickened out, but once we start to go negative in growth, the Fed walks completely away from providing economic or inflationary discipline in the markets in terms of like generating higher rates. So when I look at what's happened over time, we can see that the average sell-off in the market on a recession is about 24%. Some of them have gone fairly significant, but I think these are very difficult scenarios to compare ourselves with. 1973, when we had the oil embargo, and we had a completely different labor market than we do now. And then 2001 and 2008, I think those were very, very different conditions that we have now. So when I think about potential price declines, I think about this 14 to 20% level, and we've already gone down a fairly significant percentage of that amount already. So that's assuming that we do have a recession, which I don't necessarily think that we can guarantee that that's going to happen. Now, let's think about this. If we didn't have a recession and it was just a growth slowdown, okay, how do we look now relative to everything else? So when we take a look at conditions where we have a recession, which is the blue vertical line, okay, across all the different equity sectors that we have, NASDAQ, S&P, Russell 2000, Russell 1000 growth, and whether we have just a large sell-off, in other words, a growth slowdown, which are the yellow lines, and then we compare that to where we were on March 8th, which was a week before the Fed rate hike. And what we see is that relative to the yellow line, we've gone down more than the average large sell-off. Now, we have not gone down as much as a recession, and don't forget, three of those recessions forced that number down substantially in terms of the average, because maybe there were 10 different recessions and 3 of them were fairly significant, so that's going to bring those down. We have not gone down as much as we would go down in a recession, but if we don't have a recession, which we have to think about, it's very possible that we don't have a recession. We've already gone down maybe enough in early March that we have a secondary test here, which we may be higher than or fractionally lower than the March 8th lows.